Piece of me, piece of my, take some time. I'm just reading all that slow, so for sure. That's just for me and my world. Insecure, for the floor. Jesus, be my God.
Here we go. Let me record. What's up, guys? Welcome back to another bootcamp video. Today we are going to be talking about liquidity, supply, and demand. Welcome to the entry videos. You guys have market structure. You guys know how to read candles. Now we need to know how to get into the market in the proper way and utilize all three sections in order to take a good trade. This entry model works on either the 15. Actually, no, it works on every single one. But there are specific rules on the 15 and the 5-minute chart. Okay, so we're going to break down those rules. I'm going to tell you guys how to use liquidity, supply, and demand. The supply and demand that you guys trade sucks because it's not real supply and demand. Real supply and demand, you have to account for liquidity. You have to account for areas of where buyers are going to step in and where sellers are at in order for your trade to be a high probable trade entry. So here we go. Liquidity and demand. That's what you guys are. This is the entry model. And we're going to be going over the 5-minute chart first, because this is going to be your majority of the time, this is going to be your day trading. Okay, let me change this to the 5-minute chart. Okay, it's on the 5-minute chart. Sick. Let me find an example. Yeah, the market's been shit. No. No. Any buys? Wow, I might have to change. Let's go to YM. No. Holy crap. Ugh. These past couple of days have been ugly, dude. Maybe I should just go on to the bigger. Actually, okay, well, I'm going to show you an example, but it's not going to be on the 5-minute chart. But this is for the 5-minute chart. I need better structure. Wow. Consolidation. Oh my goodness. What is going on? That's not one. Excuse me. I'm gonna have to edit this video because it's taking a long time to find one. Damn, if you were doing this type of trading, you would not have an entry for a very long time.
So you're gonna edit this video, Nate?
No. All right.
Oh.
I found an okay one. Okay, here we go. Liquidity, supply, and demand. Sorry it took so long to find it. But the way you mark off your demand zones or your supply zones, this is how you're going to do it. So your supply zones and your demand zones. So supply zones located at resistance, right? And you identify it by the candle that causes the move. So candle. So the candle that causes the move down, okay? So when we're looking at the chart right here, right? It would be, you see this move down right here? This would be the candle that caused the move down. So that would be your supply zone, right? So you would mark off the whole candle, make a box, and move it to the right. Okay, with supply and demand, the way to properly do supply and demand. So let's say we're taking a supply. When you hit a supply zone, you want to take a sell. When you hit a demand zone, you want to take a buy, right? So for example, like this would be a supply zone right here. So a supply zone would be a push, pause, push. Okay, so push, pause, push. This is the supply zone. Or we call it a base, right? That would be the base. And same thing with demand zones. It would be a rally, base. No, sorry. It's those are continuations. Damn, I'm getting myself confused. So it's the opposite. So it'd be a push, base, and then a drop, right? For a drop. Oh my god. So it's a drop, base, and then a rally. That would be a demand zone. There we go. So drop, base, rally. And then for a supply zone, it would be a rally, base, drop. Okay? So the way to do this is you find the last candle that caused the move down, right? And then you want to see 2 or more candles going in the opposite direction. Okay? So this is not really a good example, but here's an example. So we need it to make 1, 2 candles going in the up direction, so at least 2 green candles without touching the supply zone, right? And then it needs to create liquidity. So this would be liquidity right here. No, sorry, up here. So this would be buy side liquidity. Up here, right? So because it didn't touch the candles, this is considered buy side liquidity. So what does liquidity need to be? What does the market need in order to move? It needs to fulfill the contracts, right?
Yeah.
So what you need is for price to break below this low first to tell you that we're in a downtrend, right? And then it needs to pull up and touch the supply zone and close outside of the supply zone. Like this. So you see how I pulled up and touched the supply zone? Once it touches the supply zone and then it closes outside, that's when you would take your sell. So you would do this. So once it closes outside, you wait for the next candle to form. Wait for the candle to, it's going to push up. And then once it flips in the direction of your trade, so because it's a supply zone, you want to take a sell. Once this candle flips to the sell side, you enter. So you would place your buy right here, your sell right here, place your stop loss above this area. No, sorry. You would place your stop loss at a little, slightly above the wick of the candle that touched. Okay, so no matter what size the candle is, you're going to place it above the one that touched. So it's going to be right here. And then you target a fixed area, okay? So you're going to target the nearest low. And it's going to be that low. Actually, there are rules to it. Hold on. I'm going to tell you the rule right now. I wrote this down in my notes. See, I should have been prepared for this video. I apologize.
Okay. Still makes sense though.
It's easier to see if I can give you like an example. Okay, so based on the stop loss size is how much take profit you're gonna take, right? If your take profit is between, so remember, write this down. I'll actually write it on the screen so you guys can. Stop loss size. So depending on where this candle wick, how big this candle wick is, because you enter right here on the flip of the next candle, right? Because that's your confirmation that that it's going into the sell side, okay? It's gonna drop into the downside. So however big this area is gonna be your stop loss.
Mm-hmm.
So stop loss size 2.5 to, so it's a minimum of 2.5. So a minimum of 2.5 ticks. So it's gonna show you. So you see how it says the number right here?
Yeah.
So this one is 27.75 because we're on NASDAQ. So each tick is actually, there's more ticks on NASDAQ than there is on anything else, right? So
Yeah.
on ES, this would probably be like maybe 3 ticks, right? But on NASDAQ, this is 27 ticks. So 2.5 ticks, you're going to target a 1 to 4.5. So your take profit would be a 1 to 4.5. So these are specific rules that you have to follow with this. So right here.
1 to 2.5.
No, 4.5.
Oh, 4.5.
Yes.
Oh, okay.
But in certain cases, so when it comes to this is going to be only for the 5-minute chart. So
Okay.
remember this. The 5-minute, so write this down also. I should have said this first. The 5-minute chart, you do not have to follow the trend. So because you don't have to follow the trend, the stop losses matter. I mean, the take profits matter a lot. Okay.
And what do you mean by you don't have to follow the trend on the 5-minute scale?
So you know how we're in an uptrend, but I'm taking this is an uptrend, right?
Mm-hmm. Yeah.
A complete uptrend. So technically I should be looking for buys, right? But this is a sell trade. So technically this is a counter trend trade. This is a very risky trade, you know, because it could reverse at any time.
Yeah.
But
Yeah.
because we're on the 5-minute chart, we do not need to focus on the trend. Because
Okay.
because on the 5-minute chart, it does not follow the trend. We only follow, because we're taking trades off of one candlestick. So we're taking trades off of 1 hour candlesticks. Okay? So the candlestick is always going to go up and down, up and down, up and down. You know what I mean? So it doesn't really need to follow the trend for these types of trades on the 5-minute. If you want a better like confidence in your trade, you can follow the trend if you want, right? Because actually, that's wrong. Here we go. So 5-minute chart, if it is a counter trend trade, you have to follow the stop loss rule. Okay, so whatever size your stop loss is, your take profit has to be this size. This is all based on statistics. Okay, but if it's in trend, your take profit can be double. So this 4.5 would be a 9. So a 1 to 9 RR instead. Okay?
Okay. That's a lot.
Yeah. That's great risk to reward. So for 2.5 ticks, you're going to go for a 1 to... Sorry, where's my colon? 1.45. Counter trend. With trend 2x TP. Okay? There's a lot more. So, if your stop loss is 2.6 to 5 ticks, your take profit is going to be a 1 to 3 for counter trend. With trend, it's going to be a 1 to 6. One to 3, and then 1 to what? Sorry. I was right. No, 1 to 6. Okay, so if you're whatever the size of your stop loss, if it's between 2.6 ticks to 5 ticks, it's going to be a 1 to 6 when you're trading with the trend. If you're trading counter trend, it's a 1 to 3. And then 5 ticks to 9 ticks, you're going to have a 1 to 2. Counter 1 to 2. Counter trend. With trend 1 to 4. You guys following?
Yeah, so the minimum 2.5 ticks.
Yeah, so it has to have a minimum of 2.5 ticks. So let's say this stop loss, you pulled it up to the wick, right? And this stop loss was only 1.5. You have to move the stop loss to make it a 2.5.
Okay. And then your take profit is 1 to 4.5, and
Yes.
the counter trend on that one.
Yes. And any
And the width.
yeah, any with trend trades following the trend, you can double your TP. So 9 to 11 ticks is going to be a 1 to 1.5 counter trend. With trend, it's going to be a 1 to 3. And then 15 ticks and up, only a 1 to 1. Counter or with trend, only a 1 to 1. So because this stop loss right here is 25 ticks, I can only do a 1 to 1. Because this is this is a counter trend trade. Okay.
15 ticks is a big gamble. Yeah, it's a big amount.
Yes, it's a very big stop loss. So that would on like on ES, that would be like this. That's how big your stop loss would be. But because this is NASDAQ, the ticks are it has more ticks. You know, so even like just this little candle is already 25 ticks. So you would take a 1 to 1 right here. Okay, now the most important rules. So on the 5-minute chart, if you are trading the 5-minute chart, entry rules. You cannot take a trade five minutes before a new 30-minute candle and you cannot enter a trade 10 minutes before a new hourly candle. Right? Let me know when you guys are done with that, and then I'll clarify. This should actually be enter, sorry, because you can still take a trade. Let me know when you're ready.
Minutes, right? 10 minutes before noon.
Yeah. Oh, sorry.
Oh, you're fine. Just making sure. Okay. Roast.
I'm good.
Nick, you good?
Yeah.
Okay. So what I mean by that is, let's say this candle entered. Oh, this is actually a perfect example. So you see this candle, right? It entered and then it closed. But you cannot enter this trade because it is 130. So this candle entered this level, this supply zone at 130. So that means, the reason why you don't do that is because when a new 30-minute candle forms and a new hourly candle forms, the volume is unpredictable, right? So you could enter this trade and place your stop loss above this low, right? But then the next candle forming, or the new 30-minute candle that formed, oh no, sorry. This would be easier. So let's say this is the 5-minute candle. Let's say this is the 5-minute candle, right? So let's say this is 1:25 p.m. If this 1:25 p.m. candle entered, you cannot take the trade because this new 30-minute candle, so the 130 candle, would be the volume would be very unpredictable. So like you would place your stop loss above here, but then this candle could blow past your stop loss and then come back down. You know what I mean? Or it could wick out and then come back down. Same with the new hourly candle. So the new hourly candle, you have to wait until the new hourly candle makes a wick up and then continues down. So for example, this is the 25-minute candle, right? This is the 30-minute candle. Once this opens, once this candle goes up and retests this zone and then goes down and closes, that's when you enter.
Okay.
So it has to be at least 5 minutes at least 5 minutes after the new candle forms. So once you see the candle make a up wick and a down, this is for sells. So once you see this candle make an up wick like this, and then it flips, then you can enter the trade. But do not enter the trade if this is the new 30-minute candle. This is the 25-minute candle. Because it's too unpredictable. Sometimes you're going to have to wait, right? So sometimes it's going to make multiple candles before it goes up into the zone again and then goes back down. So it could do this, like how it's making a bunch of wicking right here. Like it's not even touching the zone again. But this one was kind of, because this is not really a liquidity supply and demand, because you need at least 2 candles here, right? So this is not a good example, but this needed, if this doesn't close in there, you want good volume, right? So like let's say the 25-minute candle went inside and you're like, oh damn, this is a great opportunity, I would wait. And then the next candle forms, you want to see a good push away from that area, or you want to see it make an upwick first and then go in the area. If it makes a big push in the area, then you could just enter, right? So like if this candle right here was this candle, I would enter, because this shows very strong selling volume already. So I'm not worried about it pulling up and taking my stop loss.
Gotcha.
But because this candle is really small, I'm worried about it going up and touching my stop loss before going down.
Yeah.
So you want to be very aware. Sometimes it's good to wait for the candle closure, right? But if the candle does close, you would have to use the whole candle as your stop loss. So you go like this.
Yeah.
And then you would follow these rules. So this would be a 45 tick stop loss. You would go 1 to 1.
Yeah.
Like that.
Okay.
So remember, candle cannot enter 5 minutes before a new 30-minute candle, and you cannot enter a trade 10 minutes before a new hourly candle. You have to follow all of these stop loss rules if you are taking a counter trend trade. If you are not taking a counter trend trade, you can double the TP. Candle must structure must create liquidity before touching the zone. At least, no, we'll do minimum 2 candles in the opposite direction. Then it has to, oh, I forgot about that part. So then it has to break structure. Okay. So, for example, right here, this is not a good example at all, actually. So, it would go, you see the supply zone, right? You guys are following me?
Yeah.
Okay, so supply zone, push away. Then it needs to make 2 or more candles going in the opposite direction to create liquidity. So it would go 1 green candle, 2 green candles, 1 red candle, 1 green candle, right? So pretend this candle is not here. These 2 green candles. So we'll go red, 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 green, green, right? It did not touch the zone.
Yep.
So this would be buy side liquidity, right? And then it needs to break structure. So the candle needs to close under this. So once this candle closes under this, you have break of structure. That means that is a confirmation that we're going down, right?
Yeah.
Or we are going up if it was buy side, right?
Right.
So once this candle breaks structure, then it pulls back to touch. So this would have to be this touch would have to be after it breaks structure,
Okay.
because you need the confirmation that you're actually going down.
Mm-hmm.
I just can't find a good example of it. It's freaking annoying. Okay, so this would be a good example, actually, right here. So you see, 1, 2, 3 green candles, right? This is a significant push, leaving back a supply demand zone, right? So this is the candle that caused the push up, right? Then it created sell side liquidity. So three red candles, and did not touch the zone, right? And then it broke structure, right here. So it would have to close above this high to be considered an uptrend, right?
Right.
So it pushed up, impulsive move, had its pause, so secondary trend, 1, 2, 3, created sell side liquidity. That means that it needs to sweep this liquidity, right, to collect orders in order to make the move up again, right? So since it broke structure, This is telling you, okay, we're 100% in an uptrend, right? So if price pulls back to this area and then does this, it enters and closes outside of the zone, you take a buy. So let's see if it actually does that. I'm gonna move this all the way to the right to see if I can. It doesn't matter how long it's been either. So like if you find a supply zone or a demand zone that has not been touched yet, and it follows all of these rules, like it pushed, created liquidity, broke structure, and then it pulled back to touch the zone, it is a valid trade. Okay, the zone cannot be touched.
Yeah.
So if, let's say these red candles came in, touched, and then came out, and then came back and touched again, not a valid trade. So it cannot have more than one touch. It has to be a fresh zone. So for example, this right here. This is a bad trade actually, because it did not close outside of the zone. But let's say this closed outside, right? Let's say this closed outside. I'm gonna make it look like it closed outside, so that way you guys can get an idea, right? So let's say it did this, right? Broke structure, came down. It created even more liquidity actually, because it had a shitload of candles going down in the opposite direction and then continuing to break structure, right? So 1, 2, 3, break a structure. Break a structure right here, came up, 1, 2, 3, break a structure, 1, 2, break a structure, right? So this is a lot of sell side liquidity and a lot of limit orders that need to be fulfilled, right? In order to push past and make a new higher high, to push past this higher high, right?
Mm-hmm.
So once it touches, we are in direction of the trend, right? So once this candle flips green, you put your stop loss below this candle. So they could have flipped green anytime, you know? So once it entered and then flipped, so you don't take it on this candle. So this candle tells you that it grabbed liquidity. So this would be the liquidity sweep, right? Or the liquidity grab, or the stop loss hunt, whatever you call it, right? So this is grabbing liquidity, closed outside of the zone. That's confirmation that market has all the order it needs to go up, right? So then you need a confirmation that it's actually going up. So this candle right here is the one that you would enter on. So this next candle, since it came back in, retested the zone, and then rejected and pushed up. So most likely it would have pushed up like right here, right? So you place your stop loss below, what, 45 or 1-to-1?
Okay.
And then boom, it hits TP on the second candle. You see?
Yeah.
Wait, go back to that blue zone.
Blue. What do you mean?
Right there, the
There you go.
little graph you did right there. Oh, okay.
Yeah.
I
So
know what you
your
mean.
stop loss is
101.
yeah. Your stop loss is 45.75. So you're risking whatever you're risking, you're gonna make. So
Exactly.
if you risk $300, you're making $300.
Okay, that's what 101. Okay,
Yeah.
gotcha.
And this is a guaranteed hit. No, I wouldn't say guaranteed, because there's nothing guaranteed in trading. That's me misspeaking. Sorry about that. So
Damn, guaranteed.
this is a very
guaranteed 1250. Fuck.
yeah. This is an extremely high. That's a better way to say it. This is an extremely high probability that it's extremely high probability that this will hit your TP.
Based on evidence and concrete. No, but
Yes, based on literally based on evidence, based on
Statistical data.
how the market works, based on statistical and historical data. So like there are people that have traded this like for years, like before even like all other shit came out. Like this is considered price action trading, right? Because you're basing everything on what the market is doing, right? Because the market is always going to make new higher highs and new higher lows, right? So if this is the original breakup structure right here to cause the uptrend, the market is always going to pull back to these areas in order to get more liquidity, in order to make a new higher high or a new lower low, right? So for example, like if I wanted to take a sell trade on this, let's say for right here, right? Let me delete this. This is actually a very valid trade if it can break structure. So this is right here, my supply zone, right? I came up, 1, 2, 3, 4 green candles, pushed away, 1, 2, 3 more green candles, and then 3 more green candles, right? So now this needs to do this. This needs to push up, break this structure right here to tell you that we're continuing down, and then pull up. What the fuck? So it needs to come from here, pull past this, close, and then pull back and then touch the area. If it touches this area, this is 100% going to go back down. If you're in session. Okay? So remember, these trades have to be in session. So because we're trading the NASDAQ, it has to be from 9:30 to 4 p.m. Eastern time. That's the only way these trades can be valid. If there's no volume, these trades aren't going to work, right? Because if there's no volume, it's basically just going to do this. It's just going to consolidate. You need volume.
Yeah.
You need volume. So you would go,
Okay.
let's say this is what? Let's say this is the 5-minute chart. It broke structure right here, right? So this is indicating that we're in a downtrend. We're going to continue the downtrend because this already broke structure right here, right?
Yeah.
Did this enter? Oh, yeah, it entered. Oh, this is actually... Oh, here's a fucking amazing example, actually. Let me move this. So right here. This is even better than it was before. So we want to do precision drawings, okay? So you don't want to include the... I know I said include the whole thing, but that's just to not confuse you guys, right? So you want to do precision drawing when you make these zones. So what you do is you want to do only the body and then the wick. Okay? Do not contain the down wick. So if this is a supply trade, you only want the body and the wick going up, right? This is actually a disgusting fucking example. I finally see it. This has not been tested at all. So like if you pull this to the side, like this is your disgusting supply zone. Like if this supply zone gets hit, oh my goodness. See? No touches. So we have 1, 2 up candles, created sell side liquidity without touching the zone right here, right? Came up again, created more sell side liquidity right here and right here, right? This is all unfulfilled limit orders that need to be fulfilled because this is an extremely strong resistance area, right? So this is creating a shitload of resistance in this area because it's rejecting so much off of this area without touching the supply zone. So that means that if it does touch, it's going to reject so hard. So this, it already broke structure twice. So we came here, built liquidity, did not touch the zone, broke structure, right? Then created more liquidity without touching the zone, and then broke structure again. So if this pulls all the way back up here, there's a very high chance that this is going to dump. Like big time.
Okay.
But remember, we cannot take the whole move because it's a very risky thing to try to take the whole move. You know what I mean?
So we will write it down or what?
So you could
Micromanage it?
you could micromanage it, I would say. So like if you had the closure outside of the zone and then you had a flip of the candle going into the sell side, right? I would enter and then I would do whatever the stop loss rule tells me to do, right? Because this is a downtrend. So you can double the TP. So let's say this was a...
Oh, yeah.
So let's say this was a 2.5, right? You would do a 1 to 4.5. And then since it's in sell side, since it's in a downtrend, you can do a 1 to 9.
Well, up to a 1.9. Oh, man.
So you can technically do a 1 to 9 here.
Oh.
right?
Hey, save that for me real quick so we can watch what happens tomorrow.
Yeah. So if this decides to pull up and touch and close outside of the zone, this is a 110% valid supply trade.
Okay.
So if it closes out, gives me a 2.5 tick stop loss, right? 1 to 9. 100%. I'm taking that all day.
Wait. Put the mouse back on it. Sorry. Hey, there you go. I just want to see the numbers.
Yeah, so this is a 1 to 9, like all day, right? And then once, I would say I would target here first, right? Because this is where resistance would be, you know? Because there's a
Right.
very good chance that, because this is a strong resistance, we have what, we have 1, 2, 3 rejections here. Technically four direct rejections.
Could bounce back up.
It could bounce back up and retrace
Okay.
before going back down. So I would
Okay.
put like 1 take profit here and, you know, take off some profit so that you're good. And then I would drag my TP above, like to right here. Like I would drag my stop loss to like right here. So I would do a break even stop loss right here. So whatever it continues to do, you know, it can continue
move
past
around.
this. It can keep going. It can go all the way to, because
Down there. Yeah. maybe go down there and
supply,
retest that.
when it comes to supply and demand, supply is always going to reach towards demand, right? And then demand is always going to reach towards supply. So let's say this trade, right? This is a strong supply zone. If it's going down, I'm going to look for a take profit that has not been touched, right? So this is an extremely strong demand zone right here
Yup.
that has not been touched yet. So we could, if we take this trade, we could take profits here and then leave the rest running to reach for here. Okay? So this would be a 1 to 12. But you already took some profit, so it's not going to be a full 1 to 12. You know what I mean?
Yeah.
But this is a disgusting trade. If this played out, like if this actually happened and the market actually touches this and then rejects heavy off of it, I'm not going to say like guaranteed, but it's a really high probability that we would go for these zones. Right? Because this is a strong supply zone. This is a strong demand zone too. So you could look to take profit here. Right? Because this is an unfulfilled area of demand. No touches right here. And this is also an unfulfilled area of demand. So you could either take profit right here. I would do you could do your 1 to 9, right? And instead of taking the full TP, you could take some off and then let it keep going and then get the rest of this if it did go here. Or it could go here, right?
Yeah.
But majority of the time, when it does go to a demand or supply zone, it's going to go 50% into the supply zone or the demand zone. So in reality, it's not a 1 to 12. It would be in the middle of this. So it would be a 1 to 13. Or almost a 1 to 14. If it decided to take this whole move. Right? But this is a lot of sell-side liquidity. I mean, this is a lot of buy-side liquidity that could be like super fulfilled. Okay, let's actually map this out. Like, let's say, let me draw it and see how many candles it would actually take on the higher time frame. So let's go to an hourly. Bro, it could 100% touch here and move down to here. I wouldn't say 100%, but it's a very high probability because this is not far. If you're looking at the chart. No, it would be 4 hour because that's a 15. Yeah, this is like, what? It took what? 1, 2, 3, 4, 5, 6 candles to come up here from here. Right? So it could take like 6 candles to come down here. So 4, 8, 12, 16. So 16 hours. In 16 hours, it could 100% touch here. And then it has, I keep saying 100%. That's completely wrong. There's a high chance that it could come up here because it has more than enough time to touch and then reject going all the way down.
Yeah.
Right? These are disgusting zones. Oh my God.
Are you gonna get this trade going or what?
Nah.
You're not gonna do that?
Nah.
Okay.
Let's send it tomorrow.
'cause on-
Sunday. Yeah.
Yeah, because it could touch this zone tomorrow, and nobody trades Sunday because there's no volume. So this
Okay.
would be a very risky trade because it could just touch here and then reject a little bit and then just break it. You know what I mean? So you always want to be in session with these trades. So like if this happened in New York, like on Monday, New York Open, I would take this. Like 9:30, 9:40, like 10 o'clock. If that shit touch that shit and then drop and give me the red candle going down, I would enter that shit. Well, in a heartbeat, bro. And I wouldn't go for the big move, you know?
Yeah.
I would just follow the stop loss rules and then probably take break even or take some profits and let some run. But I wouldn't target
Yeah.
that far down because that's a really big move. Because it would have to drop, what, let's say from here. Let's give it a little bit of room. So like from here all the way down, it would have to drop 1.5%. Well, 1.47%. And it would have to drop. Oh no, this is 9 bars. So it would take 9 candles. So 2.5 hours on the 15-minute chart for it to reach here. But that's 380 points. I mean, 1,500. No. Yeah, that's 380 points. That's a lot of points. I mean, a lot of ticks. No, that's points. Sorry. Yeah, so this is 380 points. That's a disgusting drop, by the way. So that means like,
Huge point.
yeah, that would mean like NASDAQ would have to like basically dump.
Oh shit.
Yeah.
God damn.
And it's not like NASDAQ is pretty strong, you know what I mean? So it's
Yeah.
unlikely that it would have that big of a dip. But over time, it could, you know, it could go up, touch this, reject, and then maybe like consolidate a little bit, drop, and then go back up, and then drop, and then go back up, and then eventually it'll touch here. But that would be like more of a swing trade than anything.
Definitely.
So like I would have to, before the market closed, I would have to close out. You know what I mean? But if I had my own account, I would definitely hold this. If I was a swing trader, I would definitely hold this all the way until it touched this. But yeah, there you go. That's the 5-minute chart. Delete this. So these are all the rules. Right? That's 5-minute chart. Now, 15-minute chart, it's none of these rules apply.
Okay.
No, not none of them.
Shit.
But like none of this, none of the TP rules apply. Okay?
Okay.
And then none of the entry rules also apply. So it would still have to do exactly what it does, right? So it still has to create liquidity. It still has to break structure, and it still has to close outside of the zone, right? But with the 15-minute chart, because it's a higher time frame now, you have to follow the trend. You cannot take a counter trend trade on 15-minute chart. Excuse me. There we go. So same thing applies. 15-minute rules must follow the trend. Supply zones located at resistance. Demand zones located at support. Mark off the candle that causes the down move or the up move. Right? So this would be your down move candle, the one that caused this one to move. The last candle. So it would be the last green candle or the last red candle to cause the impulsive move to cause the impulsive move. So in this example, it would be this candle causing this impulsive move. So you would mark this as your demand zone. In this example, it would be this green candle that caused your drop to make your supply zone, right? Structure must create liquidity. So like I said, it has to break structure. No, it has to create liquidity, so meaning it has to have multiple candles, at minimum 2, going in the opposite direction, and then it needs to break structure, right? And then your take profit rule, TP rule, must be located at previous. That's spelled previous, right? Previous, yeah.
Yes.
Previous high or previous low. Okay? So these are the only rules. Oh no. And then stop loss can only be a minimum of 30 ticks. So let me know when you guys are done with that. My fucking leg fell asleep. No, not minimum, maximum, sorry. Can only be a max of 30 ticks. So you can't draw a stop loss bigger than 30 ticks. So like for example, let's say this entered the supply zone, right? And I put my tool, boom. This stop loss, I can only draw a maximum of 30 ticks. So like it can only be up to right here. Like let's say this wick was bigger than 30 ticks. I have to put my stop loss at 30 ticks. That's the max. But this one would be depending on when you entered. So no, let's say this was the candle. Let's say this is the candle that entered the zone and rejected, and then this is the one that flipped. Right? So you would do this. Your stop loss can only be right here. Okay? But then you can only target the previous low. So this is the only target. Right here. This area right here is the only target. So you would make a 1 to 4.7 17 right here.
That's nice too. Yeah, there was a good chunk of change on that. Yeah.
Mm-hmm. And these are also very high probability as well because of the liquidity rule. Because it has to gather orders. When it has more orders, you have strong momentum. So there is no hourly thing that you have to follow here. There's no, actually no. I would still kind of avoid an hourly candle, you know, because an hourly candle has a good amount of volume to like maybe stop you out, you know.
Mm-hmm.
But the 30-minute candle, you don't really need to pay attention to. I would just pay attention to the hourly candle, but it's not needed. I pay attention to it just in case, because the volume of a new hourly candle is very unpredictable. So like for example, like right here, like see this hourly candle, this 10 a.m. candle, like we had big momentum, right? And then all of a sudden it's just, I don't know what to do. Big wick up,
Yep.
small wick down, small body, you know what I mean? And then randomly just another big candle again right after that, 15 minutes after that. So like I would avoid hourly candles, or I would wait to see what the hourly candle is doing first before I enter.
Mm-hmm.
But yeah, there you go. That is liquidity, supply, and demand. Remember, with the 15-minute chart, if you're going to trade on the 15-minute chart, these trades are going to last a little bit longer. They have to be in trend. These trades, minimum, they last me like maybe 2 to 3 hours. But I probably have like a 90% win rate on these types of trades. So you have a good chance of hitting take profit. The 5-minute chart, I have about like an 80-something% chance of hitting TP. My win rate is like 84 or 85%, on the 5-minute chart. Because that one you can take, like, you know, it's the counter trend trades and the with trend trades, because the trend doesn't really matter. But the 15, because you're following the trend, you know, it has more power. It has more oomph. You could still follow the trend on the 5-minute if you wanted, but you would see less entries. 15-minute also. These types of trades don't pop up every single day. Just remember that. But these make you the most RR because they're so freaking crazy. So they don't pop up every single day, but they're very high quality trades.
Good with that.
You guys are good?
Yeah.
Okay. So there you go. That was the liquidity, supply, and demand trade model. If you guys are confused, just keep watching this back. If you guys have any questions, just ask me in the comments section below. Make sure to like, subscribe, and share the video. Remember, this is the only way to trade supply and demand. If you're not trading supply and demand this way, majority of the time, you're not making a lot of money. Because, like, look, this is technically a demand zone. Look, you have multiple touches, right? And it's not going nowhere. This is technically a supply zone, right? This is super low. Like, with this type of, what, you got like a 1 to, I mean, technically, yeah. That's all right. But these aren't really high probability trades, you know what I mean? Like, you got a 1 to 2.56. But you would have to go in with like a shitload of contracts in order to get that. To make even like any type of money. Like, even with like one, let me actually see. Buy. Let's go with 1 mini. What? Oh, well, it is NASDAQ, so that makes sense. So you would technically make, yeah. That's not bad, actually.
Oh, we don't.
Well, let's see.
NASDAQ got that juice, man.
Yeah, NASDAQ is kind of scary, to be honest with you. Let's say it touched here with one contract for a liquidity supply and demand trade. So supply, touched here, and then you target the next zone.
Oh my god.
That's disgusting, dude. So this would be, what, this would be a, what, minimum 30? Let's say you do a minimum of 30 ticks for your stop loss. It would be a $695 risk, and you would make $5 grand. That's disgusting.
What the? What the?
That's with one. That's with one mini contract.
Yeah, 1 mini. That's cool.
With micros. Let's say you did 5 micros. That's half a mini. You would make what, 25? Yeah, 2,500, and you'll risk only 300 something bucks.
Nice.
Yeah, so that's disgusting. Anyways, there you go, guys. That is the goated low liquidity supply and demand. Gave you every single rules. Now you guys know how to trade it. I hope this makes you guys money, because this made me a good amount of money. I'm not even gonna lie to you. This helped me pass a bunch of evals. Okay, thank you guys for watching. Remember, like, comment, subscribe, and I'll see you guys in the next video. We're going to be going over another entry model that you guys can also use, but this is not a day trading model. I mean, this is a day trading model. This is not an intraday model like the supply and demand trade is. the supply and demand entry is. These next two models that I'm going to show you, the ones that I use on a daily basis, are going to be for day trading. So I'm in the market and out the market within like maybe 13 seconds to like 3 minutes at most.